the best of money matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements on the SGX. Well, Singapore shares dipped today amid mixed trade in Asia. So the Straits Times Index was down 0.06% at 4,300 points at about 1:15 p.m. Singapore time. And that's with a value turnover of some 850 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI ended in the red as well, down 0.12% at 4,297 points. In terms of value turnover, that's 1.57 billion Sing dollars. Gainers trailed losers 233 versus 315. Top advances for today we've got for you GMX USD, Jardine Cycle and Carriage and UOI. And top decliners we've got here Asus, Hong Kong Land US dollars and New Incorporation USD. While in terms of counters to watch, we have the local boss operator SGX because the group today launched new indices that track next tier of large and liquid mainboard companies beyond the 30 constituents of the STI. Now, elsewhere from how the Singapore government said today that it has extended the 4% interest rate floor for interest earned on all special MediSave and Retirement Account monies for another year for CPF, to how Warren Buffett's Berkshire Hathaway has fully exited Chinese automaker BYD. More financial and corporate headlines remain in focus today. And joining me on the line on a Monday is David Kuo, co-founder at The Smart Investor. Mr. Kuo, are you there?
I am there. I am here. And it's not just Optus that has technical problems. It sounds as though you and I have technical problems as well.
Let's not get ahead of ourselves. We do have a packed show and a packed agenda for Market View today. But let's talk about the STI. Any surprises if we look at the biggest movers?
Well, I tell you what, it was more interesting to watch paint dry than to actually watch the Singapore market today. It didn't really do an awful lot. At the end of the day, it was only down about 0.12%. What is interesting, Tian Tian, is that generally in the Singapore market, when banks do well, REITs don't. And when REITs do well, banks don't. What happened today was that both banks and REITs didn't do particularly well. And I think we can probably read into that as being people don't really know which direction interest rates are going. I know we had that big meeting last week when the Federal Reserve cut interest rates, but I think it is not very clear what is going to be happening in the future. A lot of people were saying that, Donald Trump has got his man on the rate-setting committee, so therefore the path for interest rates is likely to be lower from now until the end of the year, and maybe interest rates will continue falling next year. But it doesn't look that way at all. It seems as though that the rate-setting committee is behaving quite sensibly at the moment. They're saying it really is going to be data-dependent. And the new guy that came onto the rate-setting committee wasn't really convincing in his argument, saying that interest rates need to be appreciably lower than where they are at the moment. So I think we're just going to have to wait and see as far as what is going to happen.
Okay. And Mr. Kuo, let's zoom in on some of the companies to watch. Yes, Optus now, talking about Singtel in particular, because Singtel's Australian subsidiary Optus experienced this technical failure that disrupted emergency call services and was linked to 4 deaths, including that of an 8-year-old boy, and that happened on Thursday. What should investors expect from Singtel from here and from the regulators as well?
I think what they're going to have to do is to find out what exactly happened. Technical failures happen all the time, just as you and I had a technical failure just then. But what you need to do is to say, is there a procedure in place when you do have a technical failure that is going to be affecting emergency services? I think that is the crucial point. And according to the reports that I've read so far, the procedures were not followed. What happened was that, yes, there were technical difficulties, the lines went down, but nobody was informed. And it took a while before the emergency services were told of a technical failure from Optus. So I think somebody's going to have to accept responsibility for this. And how high it goes really depends on both Optus and also Singtel, because Optus is a Singtel subsidiary. So they're going to have to try and find out. I mean, this isn't the first time that something has happened over in Australia. They had that cyber attack, if you remember, and heads rolled then. I mean, the head of Optus had to leave as a result. I don't know whether this is going to be the same situation again, where somebody is going to have to take responsibility and fall on their sword and probably leave the company as a result, because you cannot tolerate this sort of thing. You should be able to pick up a phone in the case of an emergency and contact somebody. But in this particular case, they couldn't, and as a result of that, there were some fatalities.
I was looking at the share price of Singtel down 1.587% at the closer. What we are looking at in terms of price movements there. But Mr. Kuo, another counter to watch is the local boss operator SGX. SGX Group today launched new indices that track the next tier of large and liquid mainboard companies beyond the 30 constituents of the STI, the Straits Times Index. How far does this live up to investors' expectations, though? I mean, we got a teaser ahead of time as well.
Well, I think it is vitally important, because what tends to happen with a lot of Singaporean investors is that we like the big caps, understandably, because they are stable and they are constantly talked about. And generally, when you want to research these companies, there are plenty of articles pointing to the large caps. What tends to happen with the mid caps is that they tend to get they fall by the wayside slightly, but the mid caps are probably more reflective of the Singapore economy than the large caps. And so if you are somebody that is living in Singapore and you are looking at, say, supermarkets, I'm not saying that DFI retail is not reflective of the Singapore economy, but to some extent, Sheng Siong is more reflective of the Singapore economy. So I think this is much needed, and I think it will boost interest in the next 50 companies, aside from the top 30. The top 30 will still be there. I mean, people will still invest in them, but it's the next 50 that is interesting, and I think this is something that I think will invigorate the Singapore market tremendously.
If you're just tuning in, we're in conversation with David Kuo, co-founder at The Smart Investor. Mr. Kuo, let's stay in Singapore. The government said today that it has extended the 4% interest rate floor for interest earned on all CPF special, MediSave and Retirement Account monies for another year. How far is this a boon for investors given the current market conditions, and any significant impact on the local market, do you think?
Okay, so I think it is much needed, because not everybody wants to invest in equities. And there are lots of people out there who are quite happy just leaving their money in cash. And you and I know that interest rates are heading lower. I know at the very start I said there is some doubt as to whether or not interest rates over in America will be trending lower. But for a lot of people, they think that it is quite likely to happen. And so at a time when it is very difficult to get a good return on cash, having a 4% floor on these accounts over in your CPF money, your ordinary account, your savings account, I think is going to be welcomed by a lot of people, because not everybody has a risk appetite and not everybody wants to jump into shares in order to sort of boost their return. So 4% is good, particularly when inflation is here in Singapore is relatively low. So on that score, I would say a lot of people will be quite happy with it. Then, of course, on the other hand, there will be those people who say 4%, I want a lot more than that.
Yeah.
And those people will continue to look at the equities market and maybe some of the more slightly riskier investments out there. But in general, I would say it's not going to shake the Singapore market a great deal, but it's going to be a boon for those people who are not very risk tolerant.
Now, across the region, Mr. Kuo, Asian markets fluctuated today as investors took a step back after last week's rally fueled by the Fed's interest rate cut. Now, if we look at Asia in particular, Tokyo led the winners because the Bank of Japan said it would sell off its huge stock of exchange-traded funds, ETFs, gradually. Any thoughts on the movements today and Japan in particular?
Surprisingly, Japan was up today. And I think part of the reason for that is because the Bank of Japan is not going to be selling off its entire holdings, which is about sort of 700 billion Singapore dollars. It's not going to be selling off all of that all in one go. It's going to take a while. Have a guess how long it's going to take, Tian Tian, to sell off those ETFs?
Was it 100 years?
100 years.
1 century.
I'm going to be 100. I'm going to be nearly 200 years old by the time they actually finish selling them off. So therefore, I don't think it's going to make a great deal of difference. They're going to be selling it off gradually, and it's not going to be shaking the market a great deal. And I think it's going to be welcome. I mean, why is the Bank of Japan holding all these ETFs? I understand in the very beginning they wanted to boost the stock market. They wanted to increase liquidity. They wanted corporate Japan to be able to raise money in the markets. I mean, that is all understandable. But a time comes when you've had enough, and therefore 700 billion Singapore dollars worth of shares in the Bank of Japan's portfolio, I think it's far too much, and they do need to sell it down. So the market will be encouraged, and I think a lot of people will be able to buy some of these Japanese shares that have been so tightly held by the BOJ.
And in the meantime, Mr. Kuo, I know we've talked about this, but let's talk more about US-China trade talks, particularly those between Trump and his Chinese counterpart Xi Jinping on Friday. Now, Trump said both sides made progress on many important issues, including a deal to sell TikTok, and he added that the pair would meet on the sidelines of an Asia-Pacific Economic Cooperation Summit in South Korea at the end of October. He would also travel to China next year. How far can this be a catalyst for markets given how much has been priced in thus far?
Well, I've told you before.
TikTok is a red herring, right? That's what you said.
I don't listen to anything that Donald Trump says because, he says an awful lot of stuff. He says that they've reached a deal with they're close to reaching a deal with regards to TikTok. And I haven't heard anything from the Chinese side saying that, yes, they have reached the deal. I think the Chinese side said that, they are happy to carry on talking. And some of the key issues, such as who is going to be owning the algorithm behind TikTok, hasn't been decided yet. And so there are lots of question marks, I think, behind what Donald Trump is saying. I think China also said that, yes, President Xi will visit America at a later date at a suitable time. Maybe that suitable time, Tian Tian, is when Donald Trump is not in the White House, yeah? And so therefore, I think we're going to have to wait and find out what exactly happens. But TikTok is, for me, still a distraction, because why are we talking about TikTok when there are so many key issues that need to be resolved? And those issues haven't been resolved yet, and we're still talking about TikTok. I don't care about TikTok, quite frankly. I'm not a TikTok fan. I don't go on TikTok. I don't dance. I don't sing. I don't show people how I cook, on TikTok. I don't think anybody is that interested in what I do anyway. But there are a lot of people out there, I understand, who like TikTok. But TikTok is not the issue. TikTok is a distraction. And I hope the two of them will get on to the key issues rather than talk about TikTok.
Okay, and in corporate news, Mr. Kuo, two pieces of news here. One is this filing showing that Warren Buffett's Berkshire Hathaway has fully exited Chinese automaker BYD. Now, the other piece of news relates to how Chery Automobile is reportedly set to price its Hong Kong IPO at the high end of a marketed range amid strong demand for the stock. How would you read into these two pieces of news in totality in terms of the outlook for the EV sector?
Okay, the two are very interesting. The first one, let's deal with Warren Buffett first. Warren Buffett bought BYD because of the batteries. That was the reason why he was interested in BYD. When BYD started going into, and this vertical integration, they started moving into cars, I think Warren Buffett gradually started to lose interest in the company because he doesn't like investing in car companies. The problem with car companies is that, number one, they have this, what we call a very high operational gearing. In other words, once you build a factory, it costs an awful lot of money to build a factory. Once you build it, that factory has got to run, and that factory has got to be able to sell whatever it produces. And the margins on manufacturing cars is not particularly high. And so therefore, I think that is one of the reasons why Warren Buffett started to lose his enthusiasm for BYD. It wasn't because BYD is not a great company. It is because BYD was moving into the car industry, and just as Warren Buffett would not invest in something like General Motors or invest in Ford, he would not invest in BYD because it is now predominantly a car company. And the second one, Chery Automobile, I think that just tells you an awful lot, that there are lots of car companies out there that are going to be floating. these companies need money, they need cash, they need investments, and they need to get onto the stock market in order to try and raise that capital. And that, we go back to what Warren Buffett is doing, is one of the reasons why he is getting out of BYD, because this space is going to be so crowded that many of these companies are not going to be able to make money, sadly.
I've got only about 30 seconds to go, Mr. Kuo, but this one, Trump's H-1B visa crackdown, how far do you see ripples of the move factored into U.S. markets and big techs today?
I think there are going to be lots of countries out there at the moment. I read a story today saying that the UK is looking at extending visas to high flyers, high performers. And I think if America is going to shut its doors to many of these technically savvy people going into America, other countries will be quite happy to snap them up, one of them being in the UK. And I think also it's going to affect the higher education sector also. I think there are going to be many students thinking twice about going into American universities and say, why don't I go somewhere else?
I see some reshuffling there that we can possibly expect in the longer term. But thanks so much for the insights today, Mr. Kuo. That was David Kuo, co-founder of The Smart Investor. Thank you so much for joining us today.
Thank you.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.